From deep in the Burbank Media District, it's time for another edition of myBurbank Talks, presented by the staff of myBurbank. Now, let's see what's on today's agenda as we join our program.
Hello, Burbank. Greg Sherwood here with you once again. And we're going to do a very different type podcast today than we usually do. I think it's something that hopefully is going to help you a lot. I know it helps me a lot, so I figured I had questions. So I got to figure you're going to have questions too. And while the subject matter, you say, oh, this is going to be a little bit boring. No, it's only boring if you don't take care of your business here. So knowledge is information. Knowing what you're going to talk, knowing what is going on in your life is important. And let's face it, if it's you versus the government, guess who's always going to win? So one thing we're talking here is taxes. Yes, taxes. And we have a great accountant in with us today. He works for CBIS DataTax. And I hate the word transparency. I hate that word. Okay. Full disclosure. CBIS DataTax is the myBurbank accountant. And Frank, who you're going to meet in a second, is actually our accountant, who has done a great job for me, who I highly recommend. And the reason he's on this podcast today, okay? They're not paying for this. This is something that I wanted to do. And I think it's something that's important for people to have a perspective on what's going on. Especially, sometimes you're just nervous about this stuff. And it's good to have somebody who can talk you through it. So once again, I want to welcome Frank Gomez to the podcast. Frank, how you doing?
Very good. Thank you. Appreciate coming on. And also like to mention, we just recently celebrated our 25th anniversary here in Burbank. So we do appreciate, the city of Burbank, our clients, everybody, the business community. It's a lot of fun to have people come out and, celebrate that with us just a few months ago.
And I know myBurbank was there at the function. Now we had some people from CBIS DataTax on before, and the question we had, and we don't know if it's been answered yet. What does CBIS stand for?
I don't believe it has finally been answered.
Okay.
People have guesses, but there's no for sure statement as of yet. We're still doing research into that topic.
That's great, But anyhow, if anybody out there knows the origins of CBIS, please let us know, because it's a mystery that needs to be solved.
Yeah.
But they're really good people. They're located over at Alameda and Hollywood Way. And like I say, I really enjoy working with them. They've really taken care of us. They've made me feel at ease, because let's face it, I'm not a tax guy. I don't know about taxes. I don't know about finance. I just know about doing what I do, and that's where my expertise goes. Well, let me a little background on Frank here. He's worked in the tax industry since 1998 in both Los Angeles and San Diego. A tax professional, multi-unit manager, and independent enrolled agent. What does an enrolled agent mean?
So an enrolled agent definitely means you have some additional studies that you do in broad topics. So it goes from individuals to businesses, other entities, and also kind of the interaction process with the IRS. They call it representation. What can you do to stand in the place of a client, help them out? A lot of times it's during maybe a collection process, some kind of trouble they might be in. But it could be just on day-to-day issues, and you take a number of tests in order to certify that knowledge and experience, and you become an enrolled agent, which is a national certification. So it means you can practice in any state across the country. Normally, taxes are kind of like state-based, each with their own either certification or rules or what it takes. And this way you can deal with the IRS on any issue for anybody across the country.
All right. Well, there you go. You work with both individuals and business entities, and I should know because you work with me individually as well as my business. Mm-hmm. Knowledgeable of the state and federal tax returns for individuals, including expatriates, okay, nonprofits, S and C corporations, LLCs, and partnerships. And in all honesty, myBurbank is a C corporation, or that's S corporation.
It's S corporation.
S corporation. Yeah. See, I don't even know what that entails and what that means. I just know when we first signed up for it that they was recommended to us, so we went that way. What it means, I have no. That's why I have people like you to help me. So, you're client oriented and you're uncovering meaningful deductions. Absolutely, maximizing tax refunds and minimizing balances due.
That's
Once
right.
again, I will attest to that. You're also a UCLA graduate. Sorry about your football team lately. I know it's a struggle right now.
Yeah.
And you work on you have additional experience in employee benefits, group insurance, and direct event marketing.
That is right.
Okay.
Yeah.
So there's the bio. So let me ask you this: what got you into accounting? What was the draw? Effectively, let me start before that. Where did you grow up?
Oh, yeah. So I did grow up here in Los Angeles. And, I went to school at UCLA, actually was an English major at UCLA.
Okay.
But at the same time, I took accounting classes at SMC, Santa Monica. And I thought, that's kind of like just a practical thing that you should know, maybe, and
Agreed.
could potentially be good if you ever did want to start a business or, anything like that. So it was kind of just like almost out of an interest or kind of like a desire to say, this is a good skill to have overall. So I did that. And I did work for a bank for a while. And then my first job out of college, I did do some accounting for a, aerospace company over in Vernon. And unfortunately, it didn't last very long. It was about 6 months or so.
But not because they had tax problems, right?
No, they actually had financial problems.
Okay. Yeah, that you can't help with.
So they actually shut down the business after that. And so, I was out of work doing accounting. So then I did a number of other things. And, just at a point where I was looking for even just some additional part-time work, I started getting back into it. And that was 98 when I started doing taxes and, got certified in California to do taxes. It was actually kind of just when actual computer software was starting to be more like familiarized and popularized. So before I didn't have to actually grind it out by hand in those days. Just so we finally got onto computers, which was nice.
It's funny. We have our little Alexa thing in here. It responds to the word computers. So that's that's kind of funny how it heard you and when it respond to you.
Okay.
So and let's face it. Everybody needs their taxes. And I can imagine how swamped you must have been from March into April every year. That you probably don't even get to sleep at night. It's probably a minimal sleep at time and just nothing but work.
Sometimes, yeah, it feels like that. And for most of those years, we had pretty much that kind of idea that we're gonna be busy February, March, April, and then kind of ease off the rest of the year till around now, with this extension season. But because of so many different, events that happen, we have seen many times in the last 3, 4, 5 years, just the extension of time for people to file, where like we were filing all the way through November last year. Sometimes, some years it was like they gave an extra month. Some years they gave like all the way till the end of the year.
The pandemic kind of changed everything for a while. It kind of changed all the rules. So let's talk about deadlines. So everybody has, of course, we know April 15th.
Mm-hmm.
I know that date very well because my dog was born April 15th. Oh, wow. So that's a little good with the bad, I guess.
Mm-hmm.
But you can file for a 6-month extension.
Yes.
And that is going to be due, actually, October 15th. Mm-hmm. So that's the first question is it too late to file? And what if you missed in April? Talk about what the filing deadlines now and everything.
Sure. So definitely you can file for an extension. So hopefully that's what you did if you were not able to file back in April. And if you did, then as an individual or a C Corp, you do have until October 15th. So that's coming up soon. We're going to hit October tomorrow. So you got 2 weeks, basically, to get everything together and filed. So that means getting it done without any kind of penalties or anything like that, right? If you were an S corp or a partnership, you actually missed your deadline if you haven't filed yet. That was last month.
Well, thank goodness we did ours back in April. You took care of me back then, so thank goodness.
That's right. So it really depends who you are as to when you have to file. Nonprofits actually have all the way until November if they filed an extension. So they kind of stagger it out so not everybody is due at the same time. I guess that kind of helps as they're processing everything. But yeah,
helps you too, you know.
It helps us too that we don't have to do everybody all at the same time, and you just have to make sure you know what your due dates are.
So let's say you missed the deadline. Okay, you just miss it. You didn't, for whatever reason, and there are probably legitimate reasons you missed the deadline besides just forgetting or I don't want to do it. But you missed the deadline, so. Is it still worth filing after the deadline? And what happens if you file after the deadline?
Right. So the biggest reason you want to file by the deadline is what I mentioned was penalties and interest. So there's going to be different penalties for different things. And if you have a balance due, there's going to be interest that kind of just accrues until you finally pay it off, kind of like a credit card. If you charge something, you have to keep paying the interest, even though you might start paying it down a little bit. Whatever's left, you keep paying.
What's the government charges for interest?
So right now it's somewhere around like 6-7%. Okay, so
not terrible.
It's not as horrible as some credit cards, but it just keeps going though. Could keep forever until you pay. Now the thing that's really more kind of harsh is when you don't file. You get a penalty failure to file, and that's a 5% on what you owe for every month or part of the month that you didn't file, and it goes up to 25%, right?
Wow.
And you get another one of those for failure to pay. So like if you didn't file, you didn't pay, you got two of those. And then the state comes in and they'll give you another one.
Of course they will.
So yes, definitely it's the most important thing is trying to get in on time, either April or with an extension, so you could stop that big penalty. The other stuff, not paying on time, there's ways to work it out, and it's a much smaller fee, so the really big one is when you don't file. But, let's say you're in that situation, you don't want more stuff to add up on top of it. And so you do want to kind of get your information together, organize, work with somebody. If you got to get bookkeeping together, do that and get it filed as soon as possible so that you can kind of stop the bleeding as soon as possible and figure out then you're on a track to be, on time again.
Okay, so somebody listening to this and they haven't filed in a couple of years and they've gotten some of these notices and they're starting to kind of panic a little bit, because who knows what the government could basically ever do to you. And they come to you and they say, hey, Frank, I haven't done this now in a couple of years and can you help me? Do you not only help them with their get filed again and get back on track, but do you help negotiate with the IRS as far as any penalties or payments and things like that to help them out?
Sure. So yeah, the first thing is obviously we want to get whatever years haven't been filed done, and we want to start from the furthest back in case there's things that might affect, the next return going forward. If you have any, like, for example, losses that are going to go forward from investments or business or something like that, or maybe credits you couldn't use at 1 year, you're going to forward them over to the next year. So we want to do that in the right order so you can maximize everything that you can deduct and take. And then with penalties, there is a good thing that, let's say you've been on time most of the time, you got a good track record, whatever, like you said, just something happened this time, you can ask for abatement of penalties, and usually as a first-time request, they'll go ahead and do that. Like if everything else has been filed, all the other past years were paid for, if you had anything due, they'll help you out and release you of those penalties that,
So the government is not unforgiving and cruel. The government can actually work with you then, and they want to help you, in other words.
The IRS is willing to help, and they're somewhat flexible. If you can communicate with them, you could probably work out something, at least to lessen the load. And yeah, that first time one will almost automatically be approved, but you do have to request it. Now, the state, they're not as flexible. It's going to take a lot more work. And like you mentioned, though, like if there's something legitimate that happened, like, for example, some of the reasons were why we moved the deadlines were floods and other natural disasters. That could be a reason why you actually just really couldn't file.
Sure.
So that could be an argument like, hey, I really wanted to, I've done everything I could, but, because natural disaster, because of illness or having to take care of somebody in your family, right? That could be a reason. So there could be different actual things that happen. Well, they'll consider that.
Legitimate things.
Yeah, legitimate things, and they'll consider that and get rid of the penalties. What they won't get rid of, though, is the interest. So if you didn't pay, you didn't pay. We're not going to add the extra penalties, but the interest will stay. And that's just how the tax code law is written. It says they have to charge interest. So they will charge the interest even if they get rid of the penalties.
Oh, at least they are willing to work with you, though. So does that have you had to deal with that a lot in your time, or?
Sure, definitely. These things come up. There's people that have these issues, and that's one of the things. As an enrolled agent, we get on the phone, we can talk to the IRS directly. We can make those arrangements.
You don't have to wait on hold for 30, 40 minutes before you can actually get a hold of somebody?
We do have to wait on hold, but we'll eventually get online with somebody, get on the phone with them, and we can work it out. And, like I said, with that first time request, most likely it's going to go through. If it's, I have had people where they say, this is my first time. I tell them it's the first time. And she's like, well, it looks like the last 3 years you haven't filed on time and you're still paying on these. So
it's the first time this year.
Yeah, the first time this year. So it's got to be, something legit like that. But yeah, we can get through. We could work with them and we can help you out.
Now, to me, the advantage of having an accountant, personal and professionally for the business, is that you are now familiar with me on a year basis. But but once you file, how important is it to review any previous year's tax returns, which now I think if they come to you and they're with you year after year, you're kind of doing that for them. But if not, how important is that?
Yeah, so it is useful both on your own or with a professional that's helping you to go back and look at the return that you filed. And it's going to be for a couple of reasons. You're going to look at what did I do last year and what did I do this year? Is there differences that I'm going to have some expectations about? Did I make more money, less money? Did I go from being an employee to an independent contractor or vice versa? Did my business change in some way? Did I hire employees? Did I have specific expenses, right? So you want to really kind of look at what happened before to compare it with what happened now. And that way you're getting prepared so that when you actually do file, you know what's going to happen. And you're also kind of trying to make some decisions too. So it's going to be just also either a thought exercise or really like a review for planning to say, are there some actions I might be able to take now that would help me out, when I do file? And, some of those kind of obvious things, like for a business, might be I was planning on buying some equipment, or I had these expenses that are coming up. Should I try to squeeze them in now at the end of the year, or should I push it off till the next year? If you have some control over when income might come in, if you want to limit your income, you may want to not invoice or get it to come in January or something like that. If you want to, maybe qualify for a loan or something, you want the income to come down, right? So it's a good time to look at everything that's going on and plan to see what's going to benefit you.
I think there's a lot of small businesses like myself out there, and of course, taxes are always daunting, and you look at it as another expense, the cost of doing business. But it's something that I think like you were saying, you got to kind of think it out a little bit, and what are your plans? And that's why it's good to have a tax professional, somebody who you can call and say, hey, give me some advice here on what you think I should do here. Mm-hmm. So do you get a lot of those phone calls during the year?
Oh, sure, definitely. And again, part of that process is then you actually come up with questions. So if you have someone that you can call, this process helps you to come up with a question you want to ask. And so we do get a lot of questions about, what should I do? What am I able to do? Some of the typical things that people can do is look at what kind of retirement accounts they have and what contributions are they going to put in, right? So everybody is probably familiar with IRAs and 401ks. These are two types of funds that you could put into to save for retirement. And the typical difference between the two kind of categories of those funds is either a Roth or a traditional, where the traditional, you're going to try to take a deduction in this year that you put the money in, and that could help you to pay less taxes now. The other choice is a Roth, whether it's a Roth IRA or a Roth 401k. You're going to put dollars that have already been taxed into the fund, and they're going to grow tax-free. And as long as you wait the specific time to take them out, you won't ever pay tax on it. So obviously, the younger you are, the longer you can leave it in the fund. That's definitely a lot more beneficial than maybe just getting a tax savings right now. So you have to look at, where you are financially and in your life and kind of make a decision. What do I want to do?
You're not a financial advisor. You're a tax expert. Do you try to counsel people a little, saying, hey, you know what? You're making this kind of money. I really recommend you put this amount into one of those types of accounts, each year. I mean, do you try to recommend that to people and give
Sure.
them that option? Because I didn't know there was a difference between the two different types of retirement accounts.
Oh, yeah. So we definitely talk to people about where they're at. And, one simple idea is, let's say you had a bad year. Okay. You made a lot less than you normally might make. If you already have an IRA that's a traditional IRA, you may want to convert to a Roth during that year, because then you'll pay less taxes. When you convert, you have to pay the taxes.
So can you have both types of accounts?
You can have both types of accounts, but the actual contribution limits account for all accounts, per year. But let's say you had already, because Roth is newer, maybe you already had put some money away, it's built up a little bit in your traditional IRA. And like I said, maybe you had a bad year, or maybe you're taking some time off to go to school, or for whatever reason, you're going to make less. So your tax rate's going to go down. So if you transferred the money into a Roth this time, you would pay the tax at a low rate instead of at your normal rate that you would be making, fully employed, or, whatever's kind of like standard for you. So that would be a good option during that year. So you want to kind of look at where you're at. Another reason could be like you're maybe right on the edge of going into the next tax bracket, where you're going to go up from 10 to 15 or 15 to 20, whatever you're on the edge of. And if you can put, the $7,000 into the IRA, that brings you back away and it keeps you in the lower tax bracket. So this would be another reason why you want to do that, because you're going ahead and saving yourself from moving up into a higher bracket.
Once again, another great reason that you need to have an accountant. And not just an accountant, but somebody who is your accountant. Because hopefully you're learning what I'm learning right now, and hopefully this is something meaningful to you, and you're seeing the benefit of having somebody that you can communicate with and get some of these questions answered, because the typical person just doesn't know these things. So I really appreciate it. I think and like I said, you've done a great job for me. I mean, there's no doubt about it. Your company and yourself personally, I've been very, very happy with. So here we come. We're going to come near the end of the year pretty soon, and what can you do at the end of the year to start getting prepared for next year's filing? Mm-hmm. And do you always? Well, let me just ask you that first. So, what can you do at near the end of the year? Because a lot of people wait till April 10th, and they'll start trying to find every receipt in the world and this and that, and they're in panic mode.
Right.
So, a good time to start is probably in January to start laying stuff out. So, what do you suggest?
Right. So actually, I would say even now to the end of the year, or maybe right before the holidays, it's a good time, because you're going to get busy at the very end. But if you can start looking over as simple as your bank statements, your credit card statements, to see what kind of expenses you had, what kind of things that you did. Remind yourself, you kind of forget, the stuff that happened earlier in the year. Remind yourself what happened personally, financially, or if you have a business in your business, and kind of start gathering that information so it's not really a big rush at the end. Like you said, in January, maybe you're like, oh, now I got to go back and find everything. Definitely, you're going to start getting documents in January that are official and companies are sending out to you. So you can't have those yet, but you can start looking at your mortgage statements, your investment statements, those kind of things to kind of get prepared for it. If you are a sole proprietor, for example, you kind of now have a pretty good idea how the year's going to end. You might already know what income is going to come in for that last quarter, or have at least a really solid idea. And you can make your final estimated payments, which is what you're paying in lieu of withholding, because you're not an employee, you're getting just direct payments to yourself. Nobody's taking money out and sending it off on your behalf, like when you get a W-2. Same goes for landlords who are collecting rents. Same goes for people that are mostly making money or making a good portion of their income from investments. They're starting to see how those investments turned out. You may not know exactly all the way till the end of the year, but definitely with sole proprietors, landlords, you pretty much kind of have a good idea on the year. So you can determine those last estimated payments, which we have one in September. We have the very last one in January. So you can kind of get ready to go, pay some stuff in so that it will lower the amount you'll actually end up paying, in April when you do file, if you filed that on time. And then besides that, you can do the things I was mentioning about retirement accounts. Think if you're going to put money in. For example, 401ks, you got to put those in by the end of the year. So if you got to alert your accounting department where you work or with your company to make that happen. With the IRAs, you do have a little more leeway because you have all the way through the deadline, usually April 15th, to make those contributions. So that could be a last minute decision, but you at least start thinking about what you want to do. Another kind of benefit that some companies have is an HSA, which is a health savings account. And that means you kind of make a hack on medical expenses where you can itemize them, you can deduct them if you itemize. But across the US, only about 10% of people, taxpayers, itemize. In California, it's a little bit higher, about 15% of the people itemize, but that means the majority of people don't. So if you have this available, you're able to essentially put money into account for your medical expenses, especially things that you already know for sure are going to happen, your insurance payments, or if you already have some treatment that's going to go on for so many months, or so many visits that the kids are going to go, so many times a year. And then you're going to deduct that out of your income without having to itemize. So it's a really great benefit, if it's available to you, to take advantage of, to have tax-free dollars.
You were saying that only about 15% of people in California itemize.
Yep.
Do you think a lot more people should be doing that? Is or I mean, because 15% is not a lot of people, and I'm sure that by itemizing you get a lot more deductions, and in the long run you pay a lot less money. Do you think a lot more people should be looking at that to do that?
Mm-hmm. So 100% of people should find out if they can itemize. Not everyone can. Because there's a comparison you're going to make between whatever the standard deduction might be that year for your filing status. So for single, there's going to be a certain one, it's around $12,000. For married filing joint, there's going to be one about $24,000. So you need to have itemized deductions higher than that standard deduction for it to help you. But you should take a look and find out. So that's one other reason why you go to an accountant to ask, what is it actually I can itemize? And through a discussion, you can find out things that you might be able to that you didn't know.
Well, let me ask you this. So you're a homeowner and you're making, let's say, $100,000 a year,
Mm-hmm.
and you really don't itemize. What are the 3 or 4 different items that people have no idea that could probably really lower your taxes down?
Mm-hmm. So Obviously, being a homeowner is one of the main reasons why you're going to start itemizing, because you're going to have mortgage interest and you're going to have property taxes. And so, definitely historically, that's been like when you become a homeowner, you start itemizing, right? Because those things are going to be deductible and they're large expenses. In addition to that, you could have charitable donations, uh, whether it's cash that you gave to nonprofits or maybe like furniture or items you give to Goodwill, those kind of things. Those are going to be the three main areas. So the thing,
Let me interrupt you real fast because I've dealt with a lot of nonprofits. And if you take stuff over to Goodwill or you donate to your local sports, whatever it is, any nonprofit, you can ask for a receipt from that organization. Now, it's nice you give them stuff, and you should give them stuff, but you can also get a benefit from that too, which you probably didn't realize, correct?
that's right. So definitely they'll give you a receipt and you're going to kind of estimate, what they might sell that. Like say if it's Goodwill or Salvation Army, they're going to sell it. So you're going to estimate what is it worth now. Okay. Once you gave it to them, what's the
be
value? And be honest. Yeah. So, but yeah, it definitely is going to be beneficial to you to add to that total. So besides the property tax, mortgage interest, and charitable donations, you do have medical, which kind of how we got into this with HSA. But the medical has a floor of 7.5%. So you're going to take the total cost that you had, like say on your insurance, your co-pays, if you had to go to the hospital, whatever, anything that you had to pay, deductibles, and you look at your AGI. So it's going to be a different number for every single person. That's not a standard number. So we look at your specific AGI, take 7.5% of that. Then whatever's above that amount, then you're going to be able to deduct that amount. And that's going to go towards your total where you're trying to beat the standard deduction. So it's a process that you go through. Not everybody will be able to, but definitely being a homeowner, it puts you more likely into that camp. Now, the thing that kind of changed the game a little bit was on the last tax policy change. We limited state taxes to $10,000. So you may pay more than that, but you're only going to get to take 10,000. Now, on the other hand, they did double the deduction.
Love our government, don't you?
They did double the standard deduction, so it weighed out a little bit. And nationally, it kind of is even. But obviously, in places where property values are high, like California, it's going to affect us adversely more so than, most of the other places in the country. So you will see that. Now, it's still worth it because sometimes you may not be able to itemize on the federal return to the IRS, but you may be able to itemize on the state return because there's going to be different limits and there's going to be things that get added back in or taken back out, like those property taxes. They'll add back in the difference maybe you weren't able to take before. So one other kind of item that you can't have on the federal return, but you do have on the state, is if you're an employee and you have unreimbursed employee expenses, meaning you had to pay for stuff to do your job. And so a classic thing is salesman, right? Salesman goes out, does a lot of meetings, have lunches, buys gifts for people, promotes the company. A lot of times it's on their dime and they may not get reimbursed for everything or mileage driving around. You have a job where you have to drive around a lot, right? Or use your own phone or internet or whatever. Those types of things. So, again, in the last tax policy change, those were taken out of the federal, but it remains on the state of California. Not every state has that, so you have to go state by state. Each state has their own rules, and some may say, nope, you can't have any of it. Some may say, oh, you could have certain ones. So they're all different when you get to the state level. So that's why it's definitely worth it to find out, can I itemize? Can I itemize on the IRS? Can I itemize on my state? It'll make a difference. You want to save wherever you can. So if you can save on state tax, that's great.
Once again, the reason you need to have your own accountant and have your own accountant, the same guy year after year, because he'll really know these kind of things for you. So let's talk a little about, depending on who the person in power is, Sometimes you hear reports, well, I'm going to hire 5,000 more IRS agents and they're going to come back to everybody. And other people say, we're going to cut back the IRS and stop hounding everybody. Mm-hmm. So are they actually, what's the status right now? And are they actually auditing people right now?
Yeah. So the status is, yes, they did get funded, to hire a lot of more new staff to go out. And their focus is obviously it's going to be to collect money. And they have started. So potentially right now, the estimate is there's about 15 million taxpayers that have balance dues that are outstanding. So that's a lot of people. They want to go find that money and bring it in. There's around 11 million people that have not filed for a given year that the IRS knows of. Right. And they want to go track those people down. And there's about 3 million people that they owe money and the IRS is ready to levy, meaning take some money away from them, whether that is garnish their wages, get into a bank account and take the money. There's about 3 million people in the situation where the IRS is ready to do that. So they have started hiring. They're not done, but they got at least their first wave or so of new recruits in there being trained and going out. And the first thing is that during the pandemic, a lot of cases where people owed money, we just stopped collecting. So the IRS said, okay, look, everything is going on right now. It's a burden on everybody. We're not going to collect. We're not saying that.
Wait. Does the IRS have a heart?
Well, sometimes they do. And, sometimes politically they pass laws that say, you can't do it right now. Right. So for whatever intention or reason, they put a pause on collecting. Okay. They didn't get rid of it. They said, we're just not going to collect it. It's still there. We're just not going to actually keep sending you letters or call you or do anything.
But we will keep charging you interest.
They may even have some portions that they stop the interest, but essentially it was on pause. But now, starting earlier this year, they send out letters. So probably if you're in that group, you've already received the first letter that was just like, hey, this is a friendly reminder. You had this bill a couple years back. We just paused, but we're coming back now. So you got to start thinking about paying. And you may have already received another letter that said, okay, now you're in the collection process. So you really do need to pay or else we're going to start moving forward in this collection process. And, IRS does take its time. So it's not going to be like overnight, boom, all of a sudden they're going to start taking your stuff. So they do give you a lot of time.
And they have that power.
Up. They do have the power, but they give you a lot of time in this buildup period that we're in right now. And so, for example, I've seen cases more like from 2017, 2018, where people owed from those years, or maybe didn't file from those years. That's what they're starting with, going back to those. But it's going to be like on a monthly cycle now. So they're going to just keep working their way closer and closer to the present, more letters going out and more people moving down that process. So that's why it's very important. If you get a letter, you need to respond to the letter. And, like we kind of mentioned a couple of times, IRS is reasonable, and you can work with them, but they will kind of accelerate if they don't hear from you. So you want to be able to, even if you say, look, I know I have this, but I can't pay, and here's reasons why. Okay, that's a start. They're not going to automatically just get rid of everything, but it could, buy you some time. You can have a workaround. You can figure out some way to solve it. There could be options for you. It could be as simple as a payment plan, right? Where you just go, well, I can afford to pay you X amount every month. All right, that could work. And then it just depends how long does that last, right? So the other thing that is possible, though, for example, like say you didn't file in 2018, IRS also has the power to go, you know what, we're going to file for you.
Oh.
We say this is what you made based on whatever information they have. And
let me guess, they don't do itemization either. They just say, here's the raw one, and this is what you got.
Yeah, so they do the least amount of any deductions or credits that you can get so they can have the biggest balance due, and then they send you that bill to go, you owe us $20,000, whatever, some amount, and you just get scared with it, and you didn't even file. So that's why we're back to filing is important, because it protects your rights. One, it gives you the ability to have the say of what goes on that return, because they're not going to look out for you. They may not have correct information also. So you want to be able to control or have the input to make sure it's correct. And that way you're protecting yourself, your interests. And that way the starting point of any collection, if they're saying 20 and you're saying 10, the starting point in 10 is a lot better than 20.
Absolutely.
So you want to have that control. And also then, again, California is going to say, hey, we saw that IRS filed this return for you. So we're going to go by what they said.
Monkey see, monkey do, right?
Yeah. We're going by what they said. And they also have rules and laws that cover that. Well, if the IRS said it, we are going to assume that it's true unless you prove to us that it's not true. So they're going to base their collection also on that number.
So in other words, their policy is you're guilty until proven innocent.
That's correct, yes. And so one other kind of thing that stems from if you didn't file and the IRS filed for you, the time frame that they have to collect extends. So normally, if you had a balance due, they have 10 years to collect. So once you get to that 10 years, like if they didn't collect, they can't collect anymore. So however you get there, it's possible you get there and then that's it. Whatever, if they got some payments from you, that's what they got. But if you didn't file a return, they have unlimited amount of time to collect from you.
Okay.
So again, by you filing, you're kind of putting a clock on how long do they have to come after you and
Statute of
those funds
limitations,
from you.
right?
Yeah.
That's interesting. I never knew that. Once again, another reason I hope you guys are listening to this podcast and learning, because this is good stuff. So, myBurbank is a business. I use QuickBooks. Now, I do not think QuickBooks is going to solve any of my problems. It does help me keep, categorizing things like that. But that's also, as far as I'm concerned, it's all it does. I mean, there's ways that you can say, okay, pay my taxes or file this tax. I don't trust it. I still want to come to an individual and say, here's what I got. And, please review this, find things that it does, because it's a computer.
Mm-hmm.
Okay. I want the human touch.
Mm-hmm.
Somebody who actually knows what they're doing. So what should, so as I say, as a business, I use QuickBooks, but then at the end of the year, I have you go through the QuickBooks for me.
Mm-hmm.
So if you're a new business or you're now an existing business, what should you really consider doing, and how do you prepare, how do you kind of put things together, especially a newer business?
Mm-hmm. So definitely for business, both starting, existing, and especially at the end of the year, the bookkeeping is very important. One, that's going to be where the tax return comes from. So that's going to be helpful. Just on a practical level, you need that in order to file. But
and not to interrupt you, but I will interrupt you. I sent you the QuickBooks stuff last year, and then you got a hold of me a couple times saying, well, what about this, this, and this? Things I had not considered and were not in the QuickBooks. Mm-hmm. So without having a true professional, things would have been missed completely.
Mm-hmm. Yeah. So you definitely need someone to either review or do the accounting so that you have accuracy, and obviously you got to categorize things as you are putting them in, right? Whether they're revenues or expenses, whatever they might be. And sometimes you may have a choice, like for example, with depreciation, you may have a choice to depreciate more up front, or put it on the normal schedule of whatever that item might
talk about depreciation for a second. What do you recommend is like a dollar threshold usually? Okay, I'll just write this all off this year, or we need to depreciate over a couple of years. Do you have any suggestions on that?
Yeah, so basically how it works is that if your item, whatever you purchase, your expenses, is going to last more than a year, there's going to be a useful life to it. So whatever, sound equipment, a car, real estate, whatever, something you're using in your business the IRS already has a life for it. It might be 7 years, it might be 10 years, it might be like real estate, 27 and a half years. So there's already something assigned to it. And what the IRS says is you should depreciate it over that time. But there's a couple ways that, let's say you've had a great year, so you want to have more expenses, right? You want to reduce that profit, or for whatever reason, it could be other business reasons, but you want to depreciate more. There's two things that you have. We've gone back and forth over the last 10, 15 years or so with accelerated depreciation, bonus depreciation, those things where it says you bought it now, it should go over 10 years, but we'll allow you to take it all today, right? Or some version of that, 80% of it today, 60% of it today. So you could make a choice to go, I'm going to do that. I'm going to take up to whatever the limit might be. There's also a thing called Section 179 where we've had that for a long time, where you can always have an option to take the full amount, up to a limit of whatever you paid on depreciable items, specific kinds, usually things like this, like computers and cell phones and cars, those kind of ideas businesses usually are using. So you can do that. It will then depreciate now, become an expense now, and lower your profit. So where you come into even have to think about it a little bit more is like, say, a business is going to have a loss, but let's think they think they're going to have a big year the next year. So they can do that depreciation. It won't show up now because you don't have anything to depreciate against, but now it becomes on reserve. So you can take it next year when I have these big clients that are coming in next year that I know I'm going to have this revenue. It's going to move forward, carry over, and now you'll take it then instead of waiting over that 10-year period. So it's definitely a thing you want to look at. It's definitely a thing as a business owner you got to have in mind. What do you think is going to happen like this year, next year? When do you think you'll need those expenses? And so definitely being able to talk to your accountant about that is a good idea so you can have a plan and time it correctly.
So you're a brand new business though, and let's face it, and this might be the first time you've ever gone into business.
Mm-hmm.
So what do you recommend right from day one instead of waiting? I should have done this or that or something else. Or anything you recommend immediately people should start doing, or at least thinking about? I mean, what about contacting an accountant like yourself just before they even start to go into business to help them through the process?
Sure. So it's definitely helpful to get an accountant, a professional involved when you're even planning to start a business, to have a discussion about how to do that. So we actually can help you set up your business as well. Choosing what kind of entity you're going to be so that that can be clearly explained to you what happens if you choose the S Corp, the C Corp, an LLC, those kind of things, which is another kind of item on the list at the end of the year here.
Let me ask you a question, though. Did I make the right decision on which letter I picked? Was that a good decision?
It's a good decision. So
okay.
Each one. So here's the thing. I was going to mention, it's on the list here at the end of the year, among other things, is if you're an LLC, for example, you can choose to be an S Corp or a C Corp, right? These are options you have. And so understanding how the revenues will flow through and who's going to get taxed, that's important so you can make a choice. You can't like go back and forth every other year, but let's say you've been an S Corp for a while, you could make a choice to change. So there's still an option to do that. You just can't do it like all the time. Like
right.
if IRS says, oh, look, you've done an S Corp, a C Corp, S Corp, you got to stop now. You got to wait for like 5 years and then.
Well, you and I are going to talk about that later today. So
then, you can maybe think again, but you got to at least stick with something for a while. But yeah, so it's not set in stone 100%. You can make some changes, and definitely dialogue with your accountant is important. So yeah, getting set up, that's one thing. Kind of projecting what you think is going to happen. Understanding what is going to be deductible and what's not deductible. Understanding about setting up an office in your home or renting an office or whatever, what your different approaches might be. So definitely all those things are important, and having a system in place for the bookkeeping or the accounting, whether it's going to be yourself with QuickBooks, whether you're going to hire somebody to work in your company, or you're just going to hire an accounting company, which we do bookkeeping for small businesses also. So we definitely can help in that on that subject to keep your books correct and make sure that they are ready for you to file at the end of the year. But besides that, having clear accounting helps you understand where your business is at. When is the cash coming in? How does the cash flow look? Do you have high times, peak times, and low times? So that in the future, obviously, the first year you can't really tell. You can make a plan, but it will show you what actually happened. So you can kind of start trying to look at it and go, well, why did it happen this way? That's another thing. It tells you what happened, so you can kind of say, why did it happen? And that's what the business owner is trying to do. So there's a lot of benefits to having that bookkeeping, or perhaps getting someone to help you with the bookkeeping to make sure it's clear, efficient, on time, accurate, all those things, and that you can ask questions too, like why is it why is this in this column, not that column? Simple things like that. Understanding depreciation, understanding how revenues come in. So it's very helpful to do that from the very beginning, because if, let's say, you let a year go by and you kind of didn't have a system, it's a lot harder to go back and now implement a system with all the stuff that happened with no system. So
Right.
as long as you pick something, at least you can be consistent going, well, I know I did it this way over this time period. And so if you do change, then you at least have consistency that you'll understand what happened up to that point.
The theme that I have gotten out of today more than anything else, and while I knew this, I never realized it, is how accounting is a very fluid thing. And it's just not every April you call your accountant and then you don't talk to them again until now. In all honesty, in the old days, you had the old H&R Blocks in these corporate places, and they'd hire 1,000 guys to come in March and April and do the taxes, and then they're all gone after that. They're not permanent employees. Where when you have a firm like we do with you, with CBIS, you're there all the time. I can call you anytime, and you have a familiarity with my business and myself. And I think it's a huge benefit of having a firm who's there all year round, because things do come up all year round. And I'm sure you get a lot of calls all the time from businesses saying, "What should I do here?"
Yes, definitely. You get you have questions just, in general over the year about things you might be thinking about. You get correspondence. So I've had people get correspondence that trying to think of who it's sent by. One person sent me a letter and it was telling them they had taxes to pay on these computers that they leased. It was a property tax. It almost looks like when you get your property taxes for your house. It's the same department that does that, but this is for stuff that you don't actually own. You're just leasing. And they asked me, like, is this real? Is this a scam or what?
Sure.
And so I looked through it. I'm like, oh yeah, it actually is for businesses. There is this type of thing. If you're leasing, the county will tax you for some amount.
They all want a piece of the pie, don't they?
Of use tax, right? So I'm like, yeah, it doesn't happen a lot, but yeah, that it's a legitimate thing. You should pay the amount, right? That's a true kind of bill. Other times it is a scam. Sometimes I've had clients where they go, hey, I got this letter. It says I should pay this. And I'm like,
Right.
Nope, it is a scam 100%. These are just companies that are sending you something that looks like a bill, hoping you'll just write a check and send it off to finance department, something they put on it that sounds like, oh yeah, that's probably real.
Yeah, we all see those emails all the time from Best Buy. And it's not really or your credit card's this or that, and it's all a scam. And things get mailed out. So that's once again another reason it's good to have an accountant you can call or communicate with, or just drop an email to saying, hey, does this sound all right to you? And I'm sure you get a lot of those on probably a weekly basis.
So we definitely hear a lot of them. And what happens actually is when you first start your business, now that you register with the county, There's a lot of companies that pay to get the information of whenever you first registered. Now they're offering, some are legit companies that are offering you things that you might need, insurance, whatever. But a lot of them are just scams. Like they're like, hey, you do this, we'll do this for you. You need to do this. And it seems like the government is telling you you need to do it, but really they're just going to take your money.
Yeah. But
And
in a lot of areas.
you got to be very alert. Now, one thing I did want to mention about new businesses is that, which there's information out there, and so some people are concerned whether it's true or not, is that based on the Corporate Transparency Act that was passed a couple years ago, there's a new registration for brand new and existing businesses that are happening this year. And what they call it is a beneficial owners information registration. A lot of words. And you file it with FinCEN, which is an agency that's supposed to fight financial crime. The purpose they say it's for is to kind of stop money laundering.
Okay.
That's the reason that they're stating we're going to do this. But essentially, if you're a business that existed before the beginning of the year, you have till the end of the year, December 31st, to register with FinCEN, and you are supposed to give information about the owners and perhaps other people that have control of the company. Maybe you have officers of the company or a board or something like that. So it's a requirement, and they haven't, the government has not put a lot of information out there, a lot of effort to promote, like, this is what you have to do. But I have had clients towards like the beginning of the year calling me like, hey, is this true? Because the one thing they do put out there is the penalty. If you don't file it on time, $500 a day.
Whoa.
And up to 2 years in jail.
Whoa.
So they put that big, penalty to say it's a pain point. You guys need to do this. And it's true. So currently that's the law. You need to do it, and you have a certain time. For those companies that existed before, you have till the end of the year. If you started a company this year, you have 90 days from the time you got your paperwork stamped that you're a company. So if you did it in January, you might be behind that 90 days already now, right?
Right.
Okay. And then next year, they're going to move it to 30 days after you get stamped as a real company. So, we could definitely help you with that, but it's a thing that's out there that there hasn't been a lot of official announcement and, advertisement so that people know clearly what they have to do. And there's definitely that penalty that they're promoting that's going to happen. And I'm sure there's still some leeway on it, but, you don't want to push it and be in a predicament if you don't have to be. If you already pass a date, you pass a date. You still want to, same thing like filing. You still want to register. You want to avoid the penalties as much as possible.
Another reason you need an accountant and a firm. Because I guarantee you that guy who works for 1 month for H&R Block doesn't probably know it or going to tell you about it. So, and if you start and another reason to start to talk to an accountant actually as you're starting your business, because there might be things like this that you have no idea about, and they can at least advise you. A good accounting firm.
Mm-hmm.
Frank Gomez, I can't tell you how much I appreciate you coming in. I said, we're doing this because for the simple reason, look at how much I learned today. And I'm sure there's a lot of people in the same boat too, that didn't, they think they're on top of things, and they probably are, but there's a lot they don't realize because this is an area of expertise. And let's face it, you screw around with the government, you're probably going to lose because they don't really care. They don't have the feeling that, others do. So, thank you for coming in. Anything else you want to say in closing?
Yeah, there's one actual other thing that I did want to mention is when you are setting up a business, if you have a choice of where it can be, obviously sometimes you don't have a choice. It's going to be at your house or it's going to be at a specific location that you need. The city that you choose also can make a difference on how much you get taxed. For example, City of Los Angeles, they tax you on your gross revenue. So gross receipts that come in.
Right.
And then it's based on what kind of business it is. City of Burbank doesn't do that. So, if you have a choice and you want to start a business, City of Burbank is a great place to start it. Not only is it really just a great business community where people enjoy working with each other, promoting each other, working with local people, but you're relieved from that city tax that you might have in city of Los Angeles and most other cities in Southern California. So think about it when you're
Yeah.
starting.
Boy, the Burbank Chamber of Commerce and the development part love you right now.
Yeah.
It's true, though. It is true. I've heard businesses talk about that.
Mhm.
You know, and you get outside of Burbank, there's a lot of things a lot of hidden fees and a lot of taxes in a lot of cities. Okay. Well, that's kind of it, everybody. Once again, I really want to thank, Frank for coming in. CBIS DataTax. They are the official accountant of myBurbank and myself, and that's why we're doing this, okay? This is not a paid podcast or a paid announcement. This is because I think it's important, and it's something that you really need to consider, whether you're in a business, even if you're just individually. Give Frank a call. I'll put his number on the screen and his information on the description so you can get a hold of him and get a hold of them there. I'm sure. Frank, how many people do you have working in the firm there?
Oh, so we have about 5 people working.
Okay.
Right now.
So there's a lot of people who knows, I get Frank, and I'm very lucky to have Frank. So anyhow, thank you everybody for listening or watching on the YouTube channel. We appreciate it, and we will talk to you again later. Thanks again.
Thank you for watching the latest myBurbank video. If you have it in your heart, please consider helping us by clicking on the super thanks down below. Or even better, go to our channel and consider a membership. Your support is what keeps myBurbank going strong.